And in the final week of the year, the margin received by electricity companies reaches 92% of revenue.
So just to be clear for our audience, you're saying this data is showing essentially of every dollar of electricity sold during that last week, 92 cents is profit, is margin.
92, yeah, that's right.
Kia ora koutou, a warm welcome to you all for this inaugural episode of Locked Out with Craig Rennie. By day, I'm the economist and director of policy for the New Zealand Council of Trade Unions. But by night, this podcast looks at the numbers in New Zealand and asks the hard questions so you can too. This is our inaugural show, and I'm very pleased you agreed to join us, and please help pass on the word to your friends. Here at Locked Out, we're always interested in what our viewers and listeners want to know, and what numbers are making them say, is that true? You can be in no doubt. If you're thinking it, we are too. So get in touch with me. I'm on X, Blue Sky, and Substack. We want to hear how we can better help you understand what's really going on, how you can navigate the numbers being thrown around by politicians and experts alike. On the show this week, we've got Ed Miller, a researcher with the Centre for International Corporate Tax Accountability and Research. We've brought Ed on because he's been looking at the electricity markets and uncovering some scary-looking numbers for us. In the past few months, electricity has somewhat fallen off people's radar. Lower energy bills in summer, combined with various things going on overseas, such as tariffs, have meant it's fallen down the economic agenda. But I think that's about to change. Wholesale energy prices are already well above their normal levels for this time of year. We've had a really dry summer, meaning that hydro lakes are really low. Energy companies have made shocking profits, if you pardon the pun, over the past few years, and there have been major job losses in paper mills, meatworks, and other major energy users. The government's also made some decisions that might spark your interest. Let's hear from Ed now. With us now is Ed Miller. Ed, why don't you introduce yourself for our audience?
Oh, kia ora. I'm Ed. I'm a researcher at an organisation called the Centre for International Corporate Tax Accountability and Research, or CICTAR. Basically, we do number crunching and corporate analysis for unions and other social movement groups.
And in the past, you've done work, including work for First Union on reports such as generating scarcity and other reports on the electricity market. What can you tell us about the electricity market right now? What's been happening in the electricity market recently?
Yeah, absolutely. Love talking about the electricity sector. Fascinating, keeps us all going. So we've had very, very high electricity prices over the past sort of 12-month period, and those are unusual. So if we were to look back over a sort of 10-year run of wholesale electricity prices, you'd see that for most of the first part of that period, they kind of in between about $50 and $150 per megawatt hour. In the last 4 or 5 years, we've seen more seasonal variation. So we have a predominantly hydro-powered electricity grid, which means that hydrology cycle, the amount of water that comes from the sky, determines the price of electricity to a certain extent, which is backed up by coal and gas on the other end. So most of the baseload comes from hydro, a little bit from coal and gas, also a little bit from geothermal, and a small amount from wind and solar. But the hydro is really the base load, and that seasonal variation that we've seen has increased over the last couple of years, particularly in the last 3 or 4 years. We've seen that sort of general price level moving upwards to more into the sort of $100 to $200 mark and if we could get the first graph up on screen, until last year, which was a very dry year, meaning that we were waiting for the rains to come and fill up the hydro dams. And you can see on the graph there that from quite early in the year, sort of April, we had prices between $200 to $300 per megawatt hour. And in August, they spiked right up to $800 per megawatt hour, the kind of the highest average wholesale electricity prices that we have on record.
And so, I was just saying, crikey, that they really do lift during that period and then sink once again.
Yeah, that's right. And there's a couple of things that happened in there. I mean, when prices hit that high peak, the most important thing that happened was that a whole bunch of manufacturers around the country announced that because of high electricity prices, that they were going to have to
Mm.
close their doors. They were shutting up shop. Hundreds, probably more like thousands of workers around the country lost their jobs. These are sort of big legacy manufacturers, largely in the wood sector, and they use a lot of energy for the work that they do. Unfortunately, those employers could no longer see a future for operating under such
Mm.
high electricity prices. The things that were happening in the electricity sector was that the generators were trying to conserve water as much as they could because it was dry. They didn't
Mm.
want to be in a situation where there wasn't enough water to generate electricity for the dams. So they bring in more coal and gas, which is more expensive to generate, but gas is getting in very short supply as well. And when prices hit that peak, you had the sort of perfect storm or imperfect storm, if you like, of not enough water in the dams to be able to keep generation going at the same time as not enough gas coming into the system to back up. So prices spiked.
So how did we get here, Ed? What's been the drivers behind these changes? Obviously, clearly, dry seasons have been one
Yeah.
thing. Been anything else that's driven those changes?
So I think there's three changes here that are important. The first that you've pointed out is really important, and that's kind of the meta narrative. We are going through a process of climate change, and as a result of that, we are having a less predictable hydrology cycle, which means the rains don't come when they're
Yeah.
supposed to as much as you'd expect. So I live here in Whangarei. We end up having some very dry periods which should otherwise be wet, and then we have these like atmospheric rivers that dump down on us. And there's no hydro dams here, but it's the same kind of cycle around most of the country where the hydro cycle is less reliable all of a sudden. And that's a problem if you have 60 to 65% of your generation coming from hydropower. So that's one thing. And that's something that we're going to have to respond to with some sort of infrastructural fix. We'll have to build some stuff to sort out the problem. On top of that, the previous government implemented a ban on offshore oil and gas drilling in 2018. That has, well, people say that some economists and people in the energy sector say that has reduced available gas in the system. We can look at that. There's a graph that shows gas production in this country, graph 2, if you could check it up. We have definitely had a decline in the production of gas. Whether it's came immediately after the offshore ban or whether it was already in the works, it's a bit hard to say, because the first sort of sign that you can see there is when gas production hit its peak, which was in 2014, 204 petajoules per year. It was sort of plateauing on a slightly downwards scope up to about 2018, and then it heads on a pretty downwards line after that. Sort of rocks up and down, but the trend is certainly downwards to where it is at now in the latest data, which was for that previous last year to the December year, 118, about 120 petajoules. So a big decline in that 10-year period from 2014 to 2024. I guess there's a question here about whether that's driven by the gas ban or the fact that there might not be enough gas to go around. Right, there's still a chunk of concessions that are available to the gas drilling companies, those big giant gas companies, and over the last 5 years, the gas industry has spent over $1 billion drilling for gas, and the proven reserves are now lower than they were 5 years ago, indicating that there might not be that much more gas to go around. Regardless, this has been the issue that the government has really jumped on, right? It's Labor's failure, so according to them, because they implemented the oil and gas ban, and therefore reversing that is going to be the only solution. And it was really the thing that the government grandstanded on most strongly, as this is the solution to the problem. We need to get gas flowing again. Whether that helps,
if we would think, Ed, if we had that challenge for 10 years, we would have done things during that period of time, that we would have known, and we would have brought other forms of energy on board. Has that been the case? Is that what they've done?
Well, I think this is the most important kind of explanation, and the one that has had the least focus in the news media, is that around about 10 or 11 years ago, we partly privatized our electricity companies. so we sold off 49% of the three of Genesis, Meridian, and Mercury. Contact had already been fully privatized in the 90s. As a result of that partial privatization, we have had an absolute collapse of investment into new renewable energy. If you can chuck graph 3 up on board, seeing the graph that I'm about to show you has it's cumulative data for the 4 gentailers. So it includes Contact, the fully privatized company, as well as Meridian, Genesis, and Mercury. And that dotted line that you can see about a third of the way along the graph is the point at which they were privatized. There's 2 lines there. The darker one is investment, so new capital expenditure, new renewable capacity, if you like. And you can see as they prepare for privatization, there's a spike in investment. They finish off all the projects, and then an absolute collapse in that number. And from 2016 through to 2020, there is less than $250 million from across the sector in new investment. And this investment here includes new corporate offices, it includes new property acquisitions, as well as new generating capacity, right? There is no money going into this. The other line is dividends, right? That's cash profits that get paid out to shareholders. And you can see that those numbers basically go in completely opposite directions. And over that whole period, you're seeing in the order of $1 billion being paid out to shareholders. So we're not having new money going into generating capacity until around about 2021. And the energy industry is a really long game. You know, it takes years and years just to get these projects consented, let alone built. So you have to plan kind of probably about 10 years in advance. We had next to no investment taking place for the better part of 10 years, which means that we're probably a whole investment cycle behind where we need to be in terms of new capacity coming in.
So it's very clear, Ed, from that chart, just for those of you following at home without the benefit of the chart, that data shows that, you know, the government and other private shareholders have benefited hugely post-privatization, but we've systematically underinvested in energy, and that might help explain quite why now we're overpaying, or we're paying the price in terms of elevated electricity prices for that lack of investment during that near decade lack of investment in the energy market. Would that be fair?
Absolutely, yeah. And if you want to put that in perspective, there's a journalist named David Williams who did a piece on Newsroom where he got data specifically from those partially privatized electricity companies, Genesis, Mercury, and Meridian, the amount of money since the partial privatization that they had put into new renewable generating capacity, and then compared that to dividends. $1.4 billion of investment into new generating capacity, renewable generating capacity, $9 billion in shareholder dividends, 6 to 1, or more than 6 to 1 in terms of dollars going to dividends versus new generating capacity. It's been an absolute cash cow giveaway for shareholders.
And so is that any different now? Is there any data telling us that, you know, what's happening to margins, what's happening to energy markets?
Yeah. Great question. So when electricity prices spiked last year, one of the really good things that the government did do, and it's very unusual that I would praise this government, but they implemented a weekly electricity price margin dashboard. What that data did is essentially told us what the margin, the profit margin of the generators was across on a week-by-week basis. So we could get live updates based on giving us information on the kind of profits that were being generated when prices were high, when prices were low, and anywhere in between, right? Because you saw very high prices and then they crashed after that when the rains came and some gas was acquired, which is another long story. At the beginning of this year, prices started going up again. And I thought, that's interesting. I'm going to go and look at the margin dashboard to get an idea of what's happening right now, because it was effectively the middle of summer. We had very, very high wholesale prices throughout the country, which is essentially the same thing as last year was happening. The gentailers were conserving their water, and because they were thinking it's going to be another dry season, and burning coal and gas in the short term, which they're the most expensive inputs. They set the price for everything else. So we had high wholesale prices as a result of that. I went to the energy margin dashboard and I found that the last data point in there was the final week of December, which I thought was very strange. So I sent an email to the Electricity Authority and said, have you somehow missed out updating to 2025 data? Because the last one that's in here is the last week of 2024, and I got an email response back a couple of days later saying, nope, we have finished collecting that data. We have a 6-month period of data, and that's all we need from now on. So
so hang on a sec. So you're telling me the government, at a time of elevated prices, at a time when there's real interest in this because we've seen job losses around the country, it stopped collecting the data to tell us whether or not energy companies, and in particular electricity companies, are making windfall profits, supernatural profits, as a consequence of the energy, the sector we find ourselves in now.
Yeah, that's right. We no longer collect that data. That's not a priority anymore for some reason. It wasn't really clear in the communications that I got back from the Electricity Authority why that decision had been taken, but that data is no longer being collected. So, of course, I did what any good researcher would do, and I went and pulled all the data, painstakingly copied each data point, because you can't pull down an Excel file from this, and decided to put it all into a spreadsheet. And that's on graph number 4, which I'll ask you to pull up in a second so we can have a look at that. Okay. So there's 4 lines here to look at. The top purple line is the revenue. This is weekly data, right? So each point you can see there's the revenue starts at around about $350 million a week in revenue. Then under that, there's a blue line. That's the costs. And between that is the shaded purple section is the margin. The interesting thing that we can see is that the margin pretty much doesn't change. It's pretty much consistent over the whole period, between about $60 to $90 million a week in margin that is being generated by these companies. And you can see in that early period that when the prices are high, that the margin is a relatively small proportion of total revenue. That's that dotted line, and that's measured on the right-hand side. So you can see that by sort of early August, the margin has fallen to around about 10%. But then when the rains come and the gas is procured, revenue collapses, falls right down to, about $100 to $200 million a week. But the margin stays exactly the same. And as we move forward through the year, right till the end of the year, and the very final week of the year, that you can see that dotted line wiggles its way upwards until it reaches the end. And in the final week of the year, the margin received by electricity companies reaches 92% of revenue.
So just to be clear for our audience, you're saying this data is showing essentially of every dollar of electricity sold during that last week, 92 cents is profit, is margin.
Yeah, that's right. This is I don't want to get too technical here. I would say this is closely measured to gross profit, which is revenue minus cost of sales. I know that's not going to be particularly helpful, but your operating costs will still be in that margin, is essentially what I'm saying. So that will include paying out wages. Probably there will be some purchases required within that, but that's the same margin throughout any week, right? So it's a pretty consistent. The challenge, of course, is to squeeze your operating costs as much as possible. But throughout this entire period, the margin that is received is around about 33% of profit. And that shows you the difference between high profit and low profit as well. Sorry, high revenue and low revenue, high cost, low cost.
So as an economist, what normally that would be signaling to me is that if you've got lots of margin, you should be investing wildly in that sector to generate new electricity, because there's lots of potential profit you can still be making. But what you're telling me previously is that we weren't investing in new generation in the past. So what's going on here? Why is there that disconnect in that space? Why is the market not working?
Yeah. I mean, there's a couple of things here. One, we talked about this being a really kind of long run industry. So the time from investment to delivery of projects is, somewhere in the order of 5 to 10 years. It's worth noting that solar is squeezing that process down significantly, particularly in the construction phase, because for solar, it's one repeated action, right? You stick a panel on a panel holding thing, and then you keep doing that 1,000 times over, compared to building a hydro dam, which is many, many different processes. So solar is making it easier to add new capacity. But there is still a problem in how the market is working. It is still not considered a competitive market. And that's kind of the response that the government has tried to favour, to say we need to work out what are the anti-competitive things that are taking place in this market that's preventing new entrants from coming in and disrupting the market, or something to that effect. One of the things that's been one of the widely discussed things in that regard is the fact that many of the best wind sites, because a lot of the new capacity that we're adding is going to be wind, because it's a lot harder to add new hydro dams because of the RMA. Basically, we have much more stringent controls on projects than we used to, which is a good thing. But a lot of the best wind sites have already been bought up by the gentailers and are sitting there not developed at the moment, not adding new capacity to the grid, because they benefit from a scarce market where they can set higher prices and get higher margins as a result of that.
So that suggests that the government should be doing something much more in this space. What other government policy responses have there been to this problem, apart from just trying to bring in some new supply in this space?
Yes, I mean, the biggest push from the government, at least last year, was let's sort out the gas problem, right? So they were trying to repeal the legislation that was supposed to be done by the end of the year. That has not been done. The legislation was bungled, the drafting of the legislation. The industry didn't like it because of problems with the decommissioning regime. It was sent back, and the drafters have been working on it. I have been checking the order paper regularly, which is where new legislation pops up to be debated in Parliament. It keeps sitting around about number 20 and doesn't move anywhere, indicating that they don't want to have the discussion. There's something wrong with the legislation. Perhaps it's the fact that even once they get this over the line, it will take somewhere in the order of 5 to 15 years to get new commercial gas onto the market. It's not actually a solution to the problem. But who knows exactly what's driving that. Some of the other things, I mean, the biggest thing probably that could have an effect is there have been a bunch of projects that have gone through the fast track process. I'm not saying I support the fast track process. I think it's an affront to democracy, but new capacity coming on, however it comes, will be beneficial to the supply demand imbalance. There is other work going on in some other parts of the economy about potentially having a regime for offshore wind, which could bring significant amounts of generation, but this is years and years away. Probably the short-term story that will come out in about June, July is there's a market review where the outcomes of that review will be published. It's being done by a firm called Frontier Economics, offshore firm with support from a New Zealand firm called Concept Consulting. It'll be interesting to see what that says, but all the kind of indications that we have at the moment is that the market's not functioning properly. Maybe this is a sector where markets alone are not going to drive the kind of outcomes that we need.
So I was going to ask you that because you've talked about a review. You've talked about some legislation that's stuck in the House for whatever reason. You've talked about long timelines. None of this is going to change anything important over the next couple of years. So what's going to happen over the next couple of years to the electricity market?
We could very well have a dry winter again, and another dry winter will almost inevitably mean that there will be more manufacturers that are being pushed to the hilt in terms of their ability to continue to procure energy at a cost where they can still generate a profit, right? So there could very well be more redundancies this year. Hopefully the government has put some measures in place to prevent that from happening. And the biggest thing that they could do in that regard is almost half, 45% of all gas that's produced in this country goes to one consumer, a Canadian methanol producer called Methanex. 95% of their production goes offshore and 100% of their profits go offshore. They don't employ large numbers of people, right? Methanex has the gas that we need and they bought it for super cheap decades ago. The government needs to engage directly with Methanex and get hold of some of that gas and have that as the security blanket. Look, I want a completely renewable grid as well, but we're not there yet. We need to have some gas in the system to make sure that we can keep the lights on and prevent some of those manufacturers from going bust. So that's the short-term picture. In the longer term, I mean, I think Hopefully there will be more supply coming on, and you could see in the generation versus dividends graph that there has been a boost in capacity, in investment in new capacity. So some of those projects will start to come online. But we need some kind of step change. The government's target is to double renewable generating capacity by 2050. We need something a little bit more significant than that, because at the same time as just keeping the lights on, we need to electrify transport, right? Everyone's buying electric cars, this kind of thing. We need to electrify industrial process heat, all of this kind of thing. There needs to be something a bit more significant than just saying we've got a target. You need a plan that gets you from where we are now to that target, because where we are now is potentially could be a pretty dark place that coming this winter.
If you excuse the pun, but in terms of, so you've talked about jobs, what does this also mean for consumers and people paying their electricity bills over the next couple of years?
Yeah, so a lot of the electricity companies have already signaled that there will be quite significant, in the order of 10% increases for residential plans coming this year. So people will already be paying more this winter, and that's probably likely to continue as well.
And do we know how many households face challenges in paying the electricity bill right now? Because electricity bills have gone up quite significantly over the past couple of years.
Yeah, great question. Towards the end of the previous government, there was some energy hardship data that the government began collecting. The 2022 figure said that there were 110,000 households, so that could be 500,000 people in energy hardship, struggling to pay bills, unable to keep houses warm, this kind of thing. We don't collect that data anymore. A little bit like the margin data, we don't collect that anymore. So targeting support is harder. I mean, probably the retailers, gentailers, know who the customers are, where there's targeted support. And there have been some excellent community level campaigns targeting those. I'm thinking about Common Grace Aotearoa, who were targeting issues around disconnections and disconnection fees, because often if you don't pay your bill and you get disconnected, then you get charged a disconnection fee on top of the bill you can't pay. To be able to get back onto the system. So there's been great campaigning around that. But the outlook for this is more and more cost in the future, right? Not just the generation is going to get more expensive, but we've underinvested in transmission and distribution, which are kind of more the government side of supply. And they will have greater investment requirements over that coming period as well, all of which adds into the bill you pay as a consumer.
So just to wrap this up for our listeners at home, you've had a long run problem. The government and other shareholders have clearly benefited from the current market structure in terms of some nice dividends that have come their way. We've known about this challenge for a long time. And we're now systematically taking away all the pieces of information that we might otherwise be able to use to help understand the problem. And we don't know in terms of jobs, we don't know in terms of industry, who this is likely to impact and why. What should the government be doing now? What should the government be tackling and delivering to help make sure this problem goes away?
Look, there's a range of views about this. I support the idea of doing a review into the market settings, but I don't think in the current situation that the market is going to solve the problem that it itself has created. It's going to require a pretty hands-on approach from government, in my view. What do we have on our side to be able to do that? We have a 51% share in 3 of the 4 biggest companies in the generation and retail parts of the sector. We should be requiring those companies through whatever means are required, whether that's shareholder resolutions or more expansive regulation, to invest, to put investment in new generating capacity ahead of paying dividends. That should be the number one first step that we can take to do that, to make sure that every consented wind project gets built within the next 2 to 3 years, to make sure that there is every other project that's not too impossible to work on gets moved forward as quickly as possible. That's sort of step 1. Step 2, I think, is to think about government itself as a big consumer of energy. Government has long-run time scales in terms of its investment. Why don't we get government to build its own solar retrofitting outfit which can go through all of the current 2,000 gigawatt hours worth of consumption that governments use, work out how to stick solar panels on all of those buildings, get the knowledge of doing that, and then use that to go through the next step, which is how do you do the local government fit out? And then once you've done all that, think, okay, well, we've developed a solar retrofitting machine. How do we start targeting the 110,000, which is probably going to be 200,000 by the time we get to this, households who are in energy poverty? Stick solar panels on all of those and work through all of those objectives, just working through each of those, pulling more and more companies off having to rely on the hydro grid and the gas grid so that there's greater energy independence and a greater ability to use the material that's in front of us. This is a challenge that we're not going to solve through a free market approach. We need creative solutions to doing this and to use the assets that are in front of us.
Well, thank you, Ed, for joining us and explaining this quite so coherently. To me, it's a terrifying problem. We've known this is coming for a long time. The market's quite clearly not delivering in the space, as you've said. The solutions appear to be in our hands, but without them, we're going to see more job losses around the country, avoidable job losses around the country, and we won't be able to deliver the energy transition that we need, because we need to tackle climate change. We know we need to tackle the moving to an electrified car fleet and other things. Quite where we are, I have no idea. But thank you for helping to explain it. Thank you for being another economist who's helped make everyone slightly depressed here. It's nice to have some company in that space. But what would you tell the audience they should be doing, just very briefly, in terms of getting this message out and making sure that decision makers are understanding that people know this is a problem?
Email Simon Watts, the electricity minister, and say, why is the margin data down? We want to know how much profit the big electricity companies are making now.
With that, thank you very much, Ed.
My pleasure.
We hope you enjoyed that interview. And if you want more details, there's a Substack with all of the findings of the research available. Search either for Ed Miller or for Craig Rennie and find all of the information there. I think it's clear. We should have all of the information on energy company margins and on household energy poverty available to us. Kiwis should know if their energy markets are working for them and if the government's actually on their side. Now, one of the things we want to do every week is look at the numbers and look at the economic data that's just happened and is coming up to us. And we want to make this a regular feature. So this week, we've seen economic data coming in suggesting that our economic growth and recovery from the recession we've had in 2024 is a bit off track. And that's before tariffs. Card spending is down in many areas. Business confidence and consumer confidence are a bit softer than many people have been expecting. The economy is probably still growing, but it's not really thriving. And these indicators are important because it will be influencing the final government decisions about the budget, which is coming up on May 22nd. I'm sure it's in everyone's calendars. We've also had big changes to the numbers of people coming into New Zealand. Migrations finally stabilized at around 30,000 new people coming into the country every year, but that's well below the peak of 129,000 people who were coming in last year. The number of people in the country has also been estimated down by Stats NZ, falling by 0.9%, giving the government more wiggle room on issues like health and on education. And that's because a lower population means less demand on government services, which should mean less spending. But it also means lower economic growth, and that means lower tax revenue. There are lots more challenges ahead for the government at this budget, and we'll be looking at all of them on this every week on this podcast. Now, looking ahead this week, the big news that will be coming out at 10:45 today on Thursday is when inflation data hits the news. When we last measured it in January, inflation was 2.2%, with inflation being comfortably inside the Reserve Bank's target range. Pressures on areas such as rates, rents, and insurance will all be pushing that number higher. But softer demand and marginally lower petrol pricing will be pushing that number lower. Markets are forecasting that CPI will be around 2.4%. If it's higher than that, the bank and the government might be in a little bit of trouble because their economic strategy is premised upon interest rates lowering the cost of living and driving up house prices. You should also keep your eye out this week on Wednesday for overseas merchandise trade data, which measures the amount of trade coming in and out of New Zealand between New Zealand and other countries. It probably will mark the high point before Trump's tariffs reduce the amount of trade that New Zealand does. On the same day, we also have research and development data coming out. What's really interesting there is trying to understand the extent to which research and development has fallen because the government cut an awful lot of spending on R&D at the last budget. Ironically, we need R&D more than ever before to grow the kind of economy we want to see in the future. Thanks so much for joining us here on Locked Out. We hope you found it in parts maddening. We hope you found it in parts enlightening. We hope you really enjoyed the interview. And if you've enjoyed the show, please give us a review or a recommendation on YouTube, on Spotify, or wherever you get your download. Locked Out looks forward to talking with you more next week. Don't work too hard. Goodbye.